Hello and welcome. Today I'm going to be analyzing a TEDx talk by Dylan Evans that I found very interesting because there are a lot of similarities between his talk and traders. So his talk is entitled What We Can Learn from Expert Gamblers. In essence, what can we learn from professional gamblers and compare that to the world of trading? If we can identify those similarities, those common traits, then we as traders can become better traders. Let's jump right in.
I've spent the last few years interviewing some of the most successful gamblers in the world, and it's not just because I like spending my time in casinos. I've got a hunch that there's a special kind of intelligence for thinking about risk and uncertainty, something I call risk intelligence. And I think we can all learn a lot about how to make better decisions by studying the way these expert gamblers think. The very idea of an expert gambler seems odd to some people. Surely gambling is just a matter of luck, they say. But that's not true. Sure, slot machines and roulette are games of pure chance, so there's no room for expertise there. But poker, blackjack, and all kinds of sports betting offer the opportunity to exercise skill and expertise. Expert gamblers outperform novices in these games, and their expertise can make them very rich.
So the same is really true in the world of traders. Most traders over a long period of time tend to lose money. So there have been studies done. There was a study done in Brazil where they studied specifically futures traders. And over a 2-year period, most of those future traders lost money. Here's what they had in common. They were all manual traders. Okay, so generally speaking, the manual trader is at a disadvantage. Okay, the same is true when it comes to gamblers, specifically when gamblers are not using any sort of a system. So what he's talking about, slots and roulette, so those are games of chance. Of course, with roulette, you can argue that you can have a methodology of money management and therefore give yourself some sort of an edge. But at the end of the day, it is just gambling. Any gambling that you're doing where you're competing against the casino or the house, you are at a significant disadvantage. Whenever you sit there, the longer you sit there on their tables, the higher the odds of you losing money. Now, there's one group of gamblers that I'm aware that they use a systematic methodology to gambling, and that's in the sports betting world. So in the sports betting world, you do have some algos that are placing those bets. So they have statistical models that they're using, and they're weighting the various factors that they're looking at, and based on that, they're making a determination as to which games they should be betting on, and what the size of those bets should be. The same is true in the world of trading. So for my system, Price Action Harvester Automated, the system essentially relies on two factors. One is historical price action, and two is current price action, what's happening currently on the chart. Now, everybody who's trading should know what current price action is, what's happening currently on the chart. But as far as historical price action, here's what I mean. What happened to particular instruments on particular days during particular times? So think of a chart, XY axis. On the x-axis you have day. On the y-axis you have time. So what happened to the SPOs? What happened to NQs? What happened to crude oil, CL? What happened to gold, GC? What happened to natural gas, NG? On particular days during particular times. So the first analysis that happens when you're doing historical price action analysis is apple to apple. You compare SPOs on Monday to SPOs on Tuesday, to SPOs on Wednesday, and so on for the rest of the week, and for particular times. But then you compare the SPOs to some other instrument, perhaps crude oil or natural gas, and you say, what happened to the SPOs on Monday at this particular time versus what happened to NG on Monday or during particular times. Your objective as a trader is to weight these things, and based on your own analysis, your own risk to reward ratio, you're trying to find the instruments that have the least amount of risk for the highest possible gain. Based on what? Based on historical price action. Meaning if you have enough of a data set where you've looked back years, not some silly 30 or 90 days or something like that, but years, and you have hundreds, even more hopefully, you should have during that years of analysis, probably around 800 to 1,000 trades that you've looked at. And then you can make a determination as to, based on historical price action, based on how those trades perform historically, make a determination if you should be trading the SPOOs, NG, or whatever else you find based on your risk to reward ratio. Let's proceed.
And it's this ability to earn money, to earn a profit from gambling, that sets the expert gamblers apart from the problem gamblers and the leisure gamblers.
Okay, he said leisure. In the States, we say leisure. Okay, so he calls one group problem gamblers. I would refer to that in the trading world, if we're looking for similarities, the cowboys. Okay, the ones who are always ready to take a risk no matter what happens. If they're wrong, they're going to move their stop. Those guys. And then the leisure ones he's talking about are the traders who essentially follow a lot of news, and once in a while they'll place a trade, and the size of the trade that they place is usually so small that they don't really worry about it. Usually they tend to be like options traders. If they lose like a couple $100 or $100, it was just fun. Okay, they like the company, and this is the options play that they made. Let's proceed.
The problem gamblers and the leisure gamblers both lose money over the long term.
Same is true in the world of
main
trading.
difference is that the problem gamblers bet more than they can afford to lose, while the leisure gamblers bet and lose relatively small amounts. But it's not really the money these people are playing for in the end. It's more the thrill of winning, the adrenaline rush of the...
We have that in the trading world, right? A lot of these manual traders, you've seen them, they glorify their trading desk, for example. They'll have 8 monitors, 10 monitors. I mean, really cool stuff, right? If you look at it, it's really cool. But at the end of the day, do they need all of that? Should they be spending all of their time doing this? It's the thrill. It's the thrill of the win that they're after. It looks cool. They have the coolest looking desktop with neon colors, and they have this amazing desk. They have a headset. They're in some sort of a Discord room or some sort of a chat group where they're having fun doing this, and it's sort of a thrill. So they're not really still, even though they have all this money that they've spent onto equipment, they still haven't reached that level where they're looking at this as a pure business. And I don't mean this in an insulting way to those that are watching that have that setup. God bless you. I hope you do very, very well. But you'll see as he goes on and as the comparisons that I make, what I'm trying to say in this video and what he's saying is essentially, what can we do to become the best version of who we are? So we're looking at this essentially as a business, not as a fun or cool thing, but as a business. Okay, as just how much money can we possibly make from this thing, and what's the least amount of risk that we can take to make that money. Let's proceed.
With the expert gamblers, things are very different. For them, it really doesn't thrill them that much to win. Think of it. If every time you pulled the arm of a slot machine, it paid out, soon it wouldn't be fun. It would be work. And for
Nothing wrong with work.
Gamblers, these expert gamblers, it is more of a cold, rational pursuit of profit that motivates them. That and a certain degree of intellectual satisfaction. And what got me interested in this group was a fascinating paper I read some time ago by 2 American psychologists called Stephen Sessi and Jeffrey Leiker. And Sessi and Leiker, back in the 1980s, fresh out of grad school, they visited Brandywine Raceway, a horse racing venue in Delaware.
Sports venue.
And they interviewed 30 avid racetrack patrons men, they were all men, they went to the racetrack every day of their working lives. They didn't make their money from gambling. It was just fun, but they were absolutely obsessed with it. They would go to the racetrack, and Ceci and Leica found that they fell into two distinct groups. 14 of them were just incredibly good at forecasting the odds, the final odds that would be offered on the horses just prior to the race, which is a pretty good guide to the probability.
So he's talking about sports betting, and I expressed earlier that there is a group that I've seen, the sports bettors, that from all the gamblers that I've seen, the sports bettors particularly, the professional gamblers, do have a system. Now, what he's going to describe in this video is a group of sports bettors that do have a system, but they don't have a automation in that system. Okay, so they're doing it manually still, even though they have a pretty cool system, and it appears to be working for them when you look at it from a long-term perspective. But it is a lot of work that they're putting in, but they're not seeing it as work because, as he described, as Dylan describes in his TEDx talk, they're having fun. So there's a camaraderie there between these 30 men that are there. They're just having fun, something to do, and it's fun. But they're really good at it. So I'm sure also they get the whole, did you win? I won. Did you win? That whole thing. So it's fun for them. But at the same time, they have a system that they have not fully capitalized yet. So the point that I want to drive home here is the comparison that I want to make is you can take a system. He's going to discuss that these men that he's referencing don't really have a statistical model in place. They do have weighting. He doesn't use that term. As I play the video, you'll see. But they do have a weighting system, sort of an internal weighting system as to how they determine the weight of each factor that they're internally analyzing, manually analyzing. But if they were able to convert that into a system, then they would remove the emotional mistakes that they would be making. Let's proceed.
The horse actually winning. And the other 16 were no better, really, than the average punter.
He says punter, that's slang, he means layperson.
So, over the course of 4 years, talking to these guys, studying them, interviewing them, Ceci and Leica figured out that the best way to model what the expert gamblers were doing when they were thinking about predicting the horse's chance of winning the race was to model it as a complex linear equation consisting of 7 variables, each of which related to the horse's performance in previous races, like its average speed, its...
Horse's performance in previous races. Compare that to trading. How did price move previously? What are the statistics? Now, I do have a tool, again, called Price Action Harvester. It's an add-on indicator. It's an analytics tool. Basically, that's all it does. It looks at the history, and it breaks it down by time. And so it looks at, let's say, the last 12 Mondays or the last 30 Mondays, and it looks at particular time, okay, broken down in intervals of time as to how price moved. And then it does analysis on that price. So if it went higher, what was the range? What's the standard? What was the mean? What's the standard deviation? What's 1 standard deviation? What's 2 standard deviations away from the mean? What's 3 standard deviations away from the mean? There you can now figure out price ranges by doing that, not just if price moved higher or lower and what the odds of price moving higher or lower are based on historical price movement, but you also have price ranges, okay, so that you can make a determination as to how much risk you have to take in the market for the potential reward that you're after. But it's not enough to just do it off of historical price action, okay? Current price action in my system plays a bigger role. I'm not going to describe exactly what my weighting system is, but my system is weighting as well. It's weighted as well, and it's basically a particular model that it's following. Now, these gentlemen that he's going to describe are doing something very similar, except they're doing it all in their head.
Average finishing position and so on. But, of course, these expert gamblers, they didn't know anything about linear regression. They'd never heard of statistical modeling. They were doing it all unconsciously. In their heads, they knew what information to pay attention to. They would gather the information consciously, but then when it came to mulling it around in their heads, they'd kind of just literally think about it somehow. They didn't know what they were doing, but then out of nowhere, a number would pop into their heads. And that number was always remarkably close to the horse's actual chance of winning.
So he's saying a number pops in their head and it's close to the horse's actual chance of winning. So if you've been doing this for a long time, anything you do for a long time, you get really good at, okay? And so they've obviously been doing it for a very long time. So what they had is they had their numbers in their head, and based on the seven different variables that they're looking at for each particular horse race, they're going to make the determination based on the weight that they've internally given to each one or assigned to those variables, and then they'll come up with the odds of that particular horse winning. And so they don't have to be right all the time. They don't even have to be right half the time, okay? Because you can position size this so that you can be right enough times where it makes sense for you to keep going back, meaning you're still making money. And so net, you're up, you're in the black. And so that's the same idea when it comes to trading. You know, it's silly to think that you can have a high win rate and that's what you need. No, you don't. I've seen many models where the win rate is between 27 and 33%, yet the wins are incredible. Okay? Because if you have tiny losses, it's all about averages. You have, tiny losses, huge wins, and you're winning about 1 out of every 3 times, and each win is about 7 times the size of each loss. I mean, the numbers just make sense. You just keep going. Okay? The longer you do this, the better you should theoretically perform. Let's continue.
The race. And it's that I call risk intelligence. It's that ability to gather information from a wide variety of sources, mull it over in your head, and come out with an estimate, a probability estimate.
Better than mulling it over in your head any given day is letting the computer mull it over, because it has no emotions connected to it. You and I are human beings. We're going to have emotions. We're going to make mistakes. Okay, you can have a bad day and make a mistake. And the typical emotional mistake that a trader makes is they move their stop. Very typical. They will move their stop. Another typical mistake that a trader makes, again, emotional mistake that they make, is they position it, the size gets all out of whack. And the reason they do that is because, let's say they have 3-4 losses in a row, which is again common. What they try to do is make it all up, and they have this break-even mentality. So they're trying to get the break-even. So they run the numbers. They go, okay, well, if I have this and if I place my trade here and if it ends up at this price, that's going to be my profit target. They do the math and they go, if I hit that profit target, I'm break-even. So they get married to this idea of this profit target is going to hit, and they hold on to that trade. And the longer they hold on, the higher the odds of them losing. Okay, and if they lose, it's going to be like 4 times the size of what their losses have been thus far. Now they're completely lost. Okay, they're completely on tilt, and either they're going to keep going and blow up their account, or they're not going to sleep very well. It's just not going to go their way. But if you had outsourced that, if you will, to an actual computer, so that you had automated trading being done, that would eliminate, for the most part, it would certainly mitigate tremendously the emotional mistakes that every trader is going to make. Okay, let's continue.
Some people, even if they find this subject interesting, they say, well, look, how can this help me actually make better quality decisions? And I think the puzzle for these people arises because we're all used to knowing how to make use of categorical information. If someone says to you, it's going to rain tomorrow, there's no brainer, you take your umbrella. But if someone says to you, look, there's a 60% chance that it will rain tomorrow, what do you do?
If I were Carl Icahn, I would say it's a no-brainer. I'll take the umbrella again. It's just an umbrella. What's the big deal?
You take your umbrella or not. We're not really taught how to make decisions on the basis of uncertain information. So I want to finish off by just describing 3 simple ways in which you can use probabilities when making your decisions. The first way is simply to set a threshold. So, for example, you might say, well, I'm only going to ask this person out on a date if I think that there's a 60% chance that they will say yes. And the great thing about this method is, of course, that everybody can set their thresholds differently at different levels, depending on how desperate you are to go on a date and how much you hate being rejected. The second...
So let's talk about that first one. So when I compare that to price action harvester automated, in the fourth version, we're in version 4 now, I added special operations, which is a second strategy. You can run it concurrently or exclusively to the main strategy being historical price action plus current price action. Special operations ignores historical price action altogether, and it is incredibly aggressive. Since adding it, I've thankfully received many compliments on it from my clients. And so I'm happy with special operations. I'm very happy with it, actually. And so with special operations, you can have your own thresholds if certain things happen in the marketplace. What do I mean by that? So it is essentially an event-driven strategy, meaning you're looking for some event to transpire, to take place, so that you make your trades based on that event. So let's say you have, right now, the reason I added it is because of all the geopolitical stuff that's happening that is causing a lot of volatility, more volatility than I've ever seen, okay? And I've been watching the market for over 2 decades. I have not seen anything like this. And so it is definitely, in my mind, a day trader's market. In my view, that's what it is. It's a terrible thing what's happening to people's 401ks. But from a day trader's perspective, this is the best volatility I've seen in a while, in a long while. Okay, I don't know if we'll see it, or I don't know how long it's going to last, but it's, foreseeably, it's going to be here for a while. Okay, because it's not just the geopolitical issue, but there is an inflation issue. There is a potential food shortage issue. I mean, COVID is not exactly resolved. There are new viruses that they're talking about. So, not COVID viruses. And so it's a lot of stuff out there that can keep this going for a while. Okay, so it's bad overall. If you step back and look at it, it's bad for people's portfolios, but it's good for day traders. And in my opinion, day trading should be part of any investment portfolio, a small subset of it, but it should be part of it, because day trading is an aggressive way to try to make more money, okay, for that attempt. So let's continue. He talked about one. He's going to talk about 2 more. So the threshold we talked about is you can say, if something is happening, I'm going to turn it on in the system, and I'll continue with the rest of the analysis.
Way to make decisions on the basis of probabilities is bet sizing. And this means betting an amount that is proportional to your confidence. So, for example...
So he said proportional to the confidence. In special operations and overall in price action harvester automated, I do have money management. And so you can not just do like the risk to reward ratio, right, and control that. You can obviously do that, but you can do other things too. You can, for example, set it so that the system will check to see if the stop that you're put in is enough near term for the market that you're about to enter. If it's not enough, it skips the trade. So that's a nice feature. Moreover, there is money management where you can say, if I've made this much money when the system is flat, or at least this much money when the system is flat, then stop looking for trades. Conversely, if I've lost this much or more when the system is flat, or you're out of trades, meaning, then it's going to stop looking for further trades. Moreover, if you have X number of consecutive losses, it's going to stop looking for further trades when the system is flat. So let's say you can put in 2. If you have 2 consecutive losses during that day, and let's say you put the stop at $200 for each trade. So if you have 2 in a row, that means you'd be down 400, right? So if you have 2 consecutive trades, then you can set it so that it stops looking for further trades. Like, that's the max risk you're willing to take that day. So in his second point, he's essentially betting the size based on his confidence. I think from a trader's perspective, you certainly have that. For example, if you're using special operations as opposed to the automated system, where that portion of the strategy of price action harvester, where it's running on both current and historical price action, remember, it's price action harvester automated is 2 strategies, 2 separate strategies. Historical price action plus current price action, that's the first strategy. Special operations, that's the second highly aggressive strategy. So if you're using the second portion exclusively, meaning that you have some threshold, meaning some if that happen. So you said, if the VIX is over 25 and it's increasing, then I'm going to look for short trades for the indexes, like the SPOOs, the NQs, RTY, YM, etc. Or the opposite is true. If, let's say, the VIX is going down and it's below 25, then you're going to say, I'm I'm looking for long opportunities. Okay, that's the first threshold. The second threshold, he talked about the bet size is based on your confidence. Same is true. So let's say you're not sure if the VIX going up and or VIX is above 25 and moving higher is not going to get faded at some point. Then if there's no news to support that viewpoint, if it's just sort of everything's status quo, then you may position it so that you're only taking a lesser amount of risk in the place. So it's confidence, but also you should, in absolute terms, not just relational terms, which is what he's discussing, right? How his confidence, but in absolute terms, how much risk do you want to take that day? So this is a number that every trader should work out. Every trader should have this number. They should know it like they know their name, okay? You have to know what your risk limit is for that day. You have to look at it because you're supposed to do that multiplication for, the entire year. But you break it down by the day. You say, I'm assuming to have X number of wins. I'm assuming to have X number of losses. I'm assuming to have this average size win. I'm assuming to have this average size loss. Therefore, on a given day, this is how much risk I'm going to take so that I can sleep comfortably at night. You should never take more risk than the risk that exceeds your comfort zone. If you've left the comfort zone, in my opinion, that person shouldn't be trading. That's my view. Okay? People who are like fretting, Saturday night comes, they can't focus, significant other talks to them, they're not paying attention at all because their thoughts are completely on the trade that they're down on, okay? Or the money that they're down on, or the worry that they have about a trade that they're gonna do, Monday morning. It's not worth it. Kids want to talk to you, you don't want to talk to them because it's going to take time away. You're stuck on your phone looking at news. You want the news to break your way so that your trade wins. I mean, if you're short, I've heard of guys looking for war. Like they're looking for war to break out. They're looking for horrible things to happen in the world so that they can win their short. I mean, when they step back and they go, I really wanted that to happen so I can win. It's human nature. I don't blame them. When you're in the fight like that, logic goes out the door. Okay? You're running strictly on emotions of fear, okay? And that makes you do things you don't want to do. And so when it comes to trading, you do have to know your amounts. You really have to know the risk that you're willing to take. And if you don't, in my opinion, know it, then consider trading. And if you refuse to do that, you refuse to take the time to know it, ask yourself this question. Should you be trading? Only you can answer that. Let's continue.
You could decide to buy more or less shares in various companies, depending on how strongly you believe that each company was going to do well.
How cool. In this video, he talks about, he just talked about stocks. He was talking about gambling, hasn't mentioned anything about stocks so far. This is the first time he notes it, where he starts talking about shares in a company. Right? He's seeing that similarity, the two worlds, the gambling world and the trading world colliding. And the reason for that is we're essentially taking risk. And the risk taker who calculates things, who takes calculated risk, has a tremendous advantage. And they have even more of an advantage if they're using proper statistics and automation, because they mitigate the emotional mistakes that one could make.
But this, of course, depends crucially on having an appropriate degree of confidence. Overconfidence is going to be fatal here.
As it
so
is in
again,
trading.
you can only use this
Never be
method of
overconfident.
decision-making if you've got good risk intelligence. The third and most complex way of using probabilities when you make decisions is to use the concept of expected value.
EV.
An expected value is an abstract concept. It doesn't refer to any actual win or loss. It refers to the average amount that you would win or lose if you placed the same bet an infinite number of times. But
okay, so placing the same bet an infinite number of times. Now, I was surprised that he didn't mention, for example, on almost all casino games, all of them, not almost, the house has an advantage, okay? The only game where the house really doesn't get involved, other than the little fees that you have to pay, is poker. And so everything else, blackjack, roulette, whatever you're playing, the house has an advantage, okay? In the sports betting world, they have an advantage. Okay, anytime you're betting against the house, you are at a tremendous disadvantage. It's only a matter of time that you lose. So the longer you sit at the blackjack table, I don't care if you read every blackjack book there is and you know it like the back of your hand. You know all the strategies, you know all the different ways that you can potentially reduce your risk. If you sit at that table long enough, you're going to lose money. The odds are against you. Okay? So, it's very, very, very difficult to get lucky that many times in a row, where if you look at it at the end of the year, you're actually up. It's very, very difficult. Okay? When you're trading against another human being and not the house. Okay? So your broker, specifically when you're trading futures, right? When you're trading stocks, they're market makers. Okay? But when you're trading futures, it's like, for example, if you're part of the CME, you're trading within the CME. So all those different futures instruments that the CME has, it's all electronic. You're not trading against, they don't want you to lose. That's not at all what the case is. So you're trading against somebody else. That's a more fair fight. Okay? When you're fighting against the house, the odds are against you. Okay? Let's continue.
Ethereal, abstract figure takes on an almost physical nature for the expert gamblers that I've interviewed. When they look at a roulette table or a blackjack game, the expert gamblers don't see the maximum amount that they could win or lose. They're not hypnotized by this like the rest of us. They just see the average amount that they could win or lose per bet, the expected value. That's what really is at the forefront of their mind.
So when you're trading, for example, in NinjaTrader, you have the strategy analyzer where you can run your hypothetical back tests. One of the parameters, one of the statistics that they provide you a lot, but one of them, of course, is the average win versus the average loss. Okay? So that's the number that you should be looking at. A lot of people, unfortunately, especially when they're first beginning, they look at the percent that they've won. So the trades that they've won, what's that percentage? Is it 90? Is it 87? Okay. The number that's the most important number isn't even necessarily the average. That's definitely high up there. But in my view, the most important number is max drawdown. How much are you down until the account started to recover again? That's your max drawdown. If your max drawdown, if you look at, let's say you run a back test, you look at the max drawdown, and that number is too high for you, you look at it and go, my goodness, I was going to be down that much, then obviously that is too much. Okay, so perhaps you may want to consider another instrument. Or if that instrument, you insist on that instrument, then perhaps that instrument has the micro version of itself so that you can take less risk potentially in the market. Let's continue.
And by placing their decisions, as it were, by thinking about this decision in this way, in terms of expected value, they place their decisions in the context of a much longer time horizon.
Same as in the world of trading, because if you're trading and you live by the day, and I get that question. I've done hundreds of Zoom demonstrations for Price Action Harvester Automated, and I get this question where people will say, "What did it do today? What did it do today?" Okay, I show them. But I always tell them after I show them, it doesn't really make a difference because today is just 1 or 2 or 3 trades. I mean, this system has approximately 1,000 trades if you look at it over the past 3.5 years or something like that. I mean, that's usually when I run the back tests, about 3.5 years. So you're looking at 1,000 trades and you're looking at the trades today. I mean, today could have been 4 wins in a row. You shouldn't be impressed. It's not impressive because it's one day. You have to have a long-term view. If you don't have a long-term view in trading, you're likely going to lose. Okay. The other alternative is you win big and you're done. Right. Nothing against that view either. Okay. My wife always tells me the story. Every time I ever talk about trading, she talks about this one kid that she went to school with, and he didn't have a car. Always complained about not having a car, and he does some bet in the market. It was an options play. It was a popcorn options play. He should have lost money. He thought he was going to lose money, but when he looked, he was actually up like 25,000 or some number like that. And he went from the winnings and he bought himself a truck. That was the only bet that he made. Okay, and he won. But that's very rare. Okay, very, very rare. So if that's how you're thinking, chances are you're going to lose, because 97 or some percent like that of those type of traders lose money. Okay, you're not going to win money. Having those kinds of thoughts, really. When it comes to day trading, you have to have a long-term approach. Just like if you start a business, right? Let's say you wanted to start a restaurant business. You know the odds are stacked against you. But you say, look, I've got $50,000 worth of capital that I can take a risk on. So I'm going to start a very, very small restaurant, okay? Very small restaurant. Something that the rent is like $800. I'm going to focus on just the delivery part of the business. The only thing I need is just a kitchen and maybe 2 tables in case somebody wants to come in, and the Uber drivers or whatever are going to come and pick up the food, okay? I'm going to focus, I'm just going to buy some kitchen equipment, and I'm going to, whatever I have left, I'm going to push with advertising. Now, I have a 90% chance of losing in the next 2 years. But what if I lost like money? I advertised and I only, I spent $200 on advertising today, but I got like $80 worth of orders. Okay, so consider your margins, you've made almost nothing. Okay, so if that happens for a few days, should you just close up the restaurant? So all that money and that effort and that planning you put in to establishing that restaurant just goes to waste? I mean, you have to have some longer period of time that you're looking at this so that you give it a chance, right? It's got to breathe. The business has to breathe. Same is true when it comes to day trading. It's got to breathe. And for it to breathe, you have to give it time. You have to have a long-term view. At a minimum, look at it by the quarter. At a minimum, that's my opinion. There are many fund managers, both on the hedge fund side and the commodity pool side, that they'll say you shouldn't even look at it until the end of the year. Okay, you should just wait for a full year to pass before you even look at it, because you have to give it time to breathe. Anyway, let's continue. He's almost done.
So they kind of rise above the moment.
Okay.
I spent the last...
that is the end of the video. I grabbed the portions of the video that I thought were the most important. I think it was a fantastic TEDx talk. I wish there are more talks about the world of risk, particularly when it comes to trading, or if they want to talk about gambling, whatever. I mean, they have to fill these seats, right? They have, but whatever's more interesting that can fill the seats in either one of those two fields, gambling or trading. Even though, people will say, is gambling, ask me, is gambling trading? Absolutely not. If you're a cowboy, it is. If you're doing cowboy trades, it is gambling. You don't know, I think it's long. Okay, therefore I think I'm just gonna go long. I think the price is gonna go higher. If you're gambling or you're doing a gut feel, or you went off of what some other guru said, then yes, it's gambling. But if you have a statistical model in place, you have historical price action and current price action, you've thought a great deal about money management and risk management, and you're using automation, then in my opinion, it's no longer gambling. It is now an actual business, and that's how you have to treat it. Business can win money, the business can lose money. Okay, both of those possibles are the realities are within the realm of possibility. Okay, you can win money, you can lose money, but it's not gambling. It is well calculated risk. I hope this video has been helpful. If you want more information on price action harvester automated, if you'd like to see a Zoom demo, I'd be happy to provide one for you. The demos last about an hour to an hour and a half, sometimes a little bit longer depending on the questions asked, but it is very thorough and I think you're going to like it tremendously. Until then, take care and God bless.